In this video, we're going to discuss VA loan requirements. Two of the biggest questions that I get are, 1, what is the minimum credit score? And 2, how do I know if I'm eligible for 0% down? Let me start off by saying that VA loans are amazing. If you are eligible, then you have a fantastic program available to you. Okay, first, the VA itself does not have a minimum credit score in their guidelines. However, a lender will have either overlays requiring a minimum credit score or the lender needs to find a VA investor who will take the loan if they have no overlays. At a minimum, we like to see a 580 credit score, but most options will be available with at least a 620. However, obviously, the better the credit score, the better the interest rate is going to get. Next, can you put 0% down? Short answer, yes, if you are eligible. You do not need any grant programs at all. You can put 0% down. The key here is if you are eligible. How do you know if you're eligible? If you are retired, discharged, or not currently serving, then you provide a DD-214 to your lender, and they can obtain what's called a certificate of eligibility from the VA. From there, the lender can calculate your eligibility through your entitlement amount to determine if you qualify for a VA loan and if you're able to put 0% down. If you're eligible and never used a VA loan before, then you should have full entitlement and be able to put 0% down. However, you would want to have your lender verify this for you before you start shopping. What kinds of things can affect your ability to put 0% down? One example would be if you have some of your eligibility tied up in a prior VA loan. It is important to remember that it is not the lender that determines if you're eligible, it is the VA. That answers the two main questions, but there are a lot of attributes of VA loans to discuss further. Let's go over a few of them. First, VA has no monthly mortgage insurance. That is right, no monthly mortgage insurance. As such, if you are eligible and put 0% down, then you will not have a mortgage insurance. As compared to conventional loans, if you put less than 20%, then you have a monthly mortgage insurance called PMI. Mortgage insurance essentially protects the lender against default since you do not have much skin in the game. However, the VA does not charge monthly mortgage insurance. Rather, they charge an upfront mortgage insurance premium called the VA funding fee. The VA funding fee can be paid in one of two ways. It can be paid as a cost at closing, or it can be funded into your loan. The amount of the VA funding fee will vary depending on whether it is your first use or subsequent or second use of the VA loan benefits. If it's your first time use and putting 0% down, then it'll be 2.3%. And if it's a subsequent use and you're putting 0% down, then it'll be 3.6%. Now, this upfront fee is comparable to the FHA loan mortgage insurance. However, FHA requires the upfront fee and they charge a monthly mortgage insurance. Another reason the VA loan is amazing. Additionally, there are situations where a veteran can be exempt from paying the funding fee. Yes, exempt, meaning you do not have to put any money down and you have no upfront fee at all. Your certificate of eligibility from the VA will tell the lender if you're exempt for paying the funding fee, which is determined by the VA and relates to service-connected disabilities. Next, an important factor of VA loans are the debt-to-income ratios. The VA debt-to-income ratio are a lot more lenient than other loan programs. If you want to learn more about the VA loan programs and the requirements, then give me a call. I'd love to go over additional requirements with you. Thank you.